Good morning, everyone. I'm Lorraine DeBono, Managing Partner at FLG Partners, which is the leading CFO and board advisory firm in the United States. We serve clients globally. Welcome to our 8th edition of CFO Insights. Today, we're really happy to have FLG partner Sandy Gardiner join us for lessons learned by a life sciences and public company CFO. And before we begin, let me tell you a little bit about Sandy and her background. So Sandy joined us in May of this year with 30 plus years of experience as an EVP and CFO of global private and public companies in the life sciences. Her tenure includes leadership positions at development stage, pre-commercial to enterprise, and mid-cap commercial biotech and medtech companies. Sandy has led numerous financial transactions, including IPOs, secondaries, private placements, reverse mergers, rights offerings, ATMs, and debt facilities. She's kind of done it all. She has raised over $1 billion in capital and completed many M&A transactions. In addition to her CFO roles, Sandy currently serves as a board of directors of Ventus Bio and board chair of the Valley Humane Society. Previously, she was with Lucera Health, Inc., where she was audit committee chair and on the nominating and corporate governance committee. So welcome, Sandy. We're delighted that you have joined us at FLG.
Thanks, Lorraine. I'm so pleased to be a partner at FLG.
That's great. So let's begin our conversation. So prior to your joining FLG, you worked as a CFO at a number of life science companies, specifically medtech and med device companies. So can you give us a snapshot of a few of the key CFO roles that you've had during your career, and then tell us about some of the milestones you've achieved at those?
Sure, absolutely. The first 16 years of my career was spent in finance positions of increasing responsibility in medical devices, focused in cardiology, and specifically angioplasty and electrophysiology. I landed my first CFO role at Lipid Sciences, a privately held biotech company pursuing HDL therapies for cardiac and viral applications. This was in the early 2000s when securing financing was challenging as a result of the tight credit conditions following the burst of the dot-com bubble. I knew we needed to get creative to raise the capital needed for growth. So in 2001, we were able to successfully complete a reverse merger actually, between Lipid Sciences and NZ Corporation, the oldest company traded on the American Stock Exchange. NZ Corporation was seeking to divest from the real estate sector to enhance shareholder value. After the merger, Lipid Sciences moved from the American Stock Exchange over to NASDAQ, and I became a public company CFO.
Great.
Since then, I've enjoyed working at both private and public companies, both large and small, over the years. At Aspire Women's Health, formerly Vermillion, I was brought in to restore compliance with the SEC and NASDAQ, subsequent to a company reorganization. I was able to do this within 6 months of being hired, actually. This was key because post-regaining compliance with the SEC and NASDAQ, we needed to pursue a secondary offering in the public markets and secure research analyst coverage. Since 2015, my medtech companies have been high-growth leaders with consumer-focused target markets. My first entree into this segment was at Ventus Medical, and it was a developer of a single nightly use disposable over-the-counter snoring device called Theravent. The successful launch of this OTC product, which included capturing the sales opportunity outside of just the core sleep apnea market, transformed the company's financial performance, taking it from a gross loss to a 35% gross margin within 12 months and a 60% gross margin within 2 years.
You know, it's interesting because I remember both Ventus and that snoring device, Theravent. Never used it, but I remember it. But it's amazing, Sandy, to go from negative gross margins to a 60% gross margin in 2 years, which, by the way, for the audience is kind of where you need to be at the very least, right? For gross margins in a med tech company. So that's pretty remarkable. So good for you. So please go ahead and continue.
Yes, and absolutely. You can, imagine it was just transformative to the company.
Totally.
So most recently, I was CFO at 2 publicly traded medtech companies in aesthetics. At Cutera, I was a member of the core team launching the company's first recurring revenue device for a very capital equipment intensive business. And at Pulse Biosciences, I completed a 250 million shelf registration, 2 oversubscribed rights offerings, a 50 million PIPE, and a 60 million ATM while preparing the organization for commercialization in the US, Canada, and the European Union.
That's terrific. And it's funny because your career so mirrors mine, both in med tech over 25 plus years, CFOs, and lots of similar experiences, except that I'm 10 years older. Sandy, I love the diversity of your experience. I know you've worked in many public and private companies internationally, as well as domestically. And I know that you're passionate about helping a company scale in preparation for commercialization and IPO, being acquired, whatever. So tell me some of the lessons that you would point to for other high growth CFOs that are trying to scale their companies.
Sure. Well, in my experience, scaling for growth begins with developing the infrastructure. But I also believe you need to be thoughtful about this. For example, I've created numerous financial models where I've walked into companies where there were none. Adding value to this adds value to the decision-making process.
Totally.
A good quality financial model with evidence-based assumptions and likely scenarios often becomes my Bible. I also believe that as a CFO, you must always push for and practice both organizational engagement and accountability. The assumptions you use for your forecasts about competitors and market dynamics should begin with the relevant experts, those that are in the sales and marketing. They're the sales and marketing leaders of the company. But it is then that the CFO's responsibility to temper the enthusiasm of the sales and marketing team, because they have a lot of enthusiasm. But in terms of expected revenues and required expenses, we really need to temper that enthusiasm. I believe this collaboration between the finance and functional areas is essential to engaging the business leaders. But of course, the CFO must always hold them accountable for results.
I love temper that enthusiasm. It sounds like Larry David and Curb Your Enthusiasm. But putting that aside, I completely agree with you because I found in my own experience, right, that collaboration of the internal teams is really essential, particularly for the CFO, right? Because the CFO and the sales and field team in particular, they really need to understand each other because the CFO really needs to learn what's happening in the field. But unfortunately, as we know, Sandy, not all executives practice collaboration. And that's
Correct.
when I think breakdown of communication happens. But CFOs and sales teams, they really need to stick together. So you go ahead.
Yes. So, I totally, agree to that because it is not only a collaborative, but, it is a way of pushing forward the business and
Totally.
making sure that everybody's on the same page.
Totally.
So, when scaling for growth, I think it's so critical to understand what's working and what's not. As a CFO, you must immediately evaluate the quality of the reporting mechanisms, process, and disciplines that are already in place. Just as an example, are reports timely in terms of helping to make better decisions and take necessary actions? If you don't have that robust reporting solution in place, how can you analyze the data and the business trends? And, if your reports aren't timely, you'll never have the time to course correct if needed. Do you have the required disciplines and automated systems in place, or is everything just a manual process? Although it's certainly not necessary for early commercial stage companies to have a large ERP system, smaller companies can still design similar processes and controls using smaller tools.
Yeah.
An abundance of manual process creates inefficiencies and is prone to just human error. You don't want to find yourself in a situation where you just have to hire more and more people to process more paper. You should always look to create efficiencies. And as the business needs change, remember that the business processes also need to change. You don't just keep doing the same thing over and over as the business grows. Finally, a common mistake in a bullish high growth organization is to go too wide on people resources right out of the gate. Hiring a large commercial field sales force and entering new territories before proving success in more narrowly focused territories. This can really show up in international expansions. I have seen firsthand the many challenges of expanding internationally because each country brings its own unique sets of requirements. The administrative costs and efforts supporting international growth, I find, are often underestimated. My advice for CEOs trying to scale is to have a solid infrastructure in place first, then hire and engage a good team and hold them accountable.
Completely agree. In my own career, I've seen too many companies in medtech, Sandy, kind of get ahead of themselves, building the huge sales force before the revenue comes in. Absolutely. And then having to then downshift, right, and lay off people when the revenue was, to be honest with you, kind of overhyped. So I totally understand what you're saying there, which is again, a CFO helps a CEO drive accountability. So let's pivot a bit now, and a couple of other questions for you. We all know as CFOs that company teams need to plan for both the short and the long term when making decisions, right? Be it about strategic moves that you need to make, when to make them, and how much investment to put in them. So share a story with us that illustrates how you as a CFO made those trade-offs.
Sure, absolutely. The clearest example of this challenge, in my view, is when companies need to raise capital. Because of the undesirable dilution effect inherent in raising additional rounds of financing, I often see companies try to thread the needle on how much capital to raise, usually citing a future inflection point and assumed increase in valuation as the best time to raise more capital. But there is an inherent flaw in this approach. It often takes longer and is more costly than planned for a company to reach the milestone projected to create that inflection point. We've seen this over and over, as you know, Lorene, as a CFO. Companies then find themselves needing to raise money ahead of the milestone achievement. Closing a financing becomes more difficult, and then with stiffer terms, because investors too want to know the results of the targeted milestone before investing. In this situation, the dilution experienced by needing to raise money quickly and ahead of plan is usually greater than had they raised more money earlier. An experienced CFO will always look beyond the forecasted timeline for milestone achievement to determine the amount needed for financing. While generating some additional dilution in the short term, this approach provides an acceptable working capital cushion for the longer term, helping position the company to better control the timing of the next financing and allowing it to weather the storm longer if needed. At Aptus Endosystems, we were able to capitalize on our early commercialization success in the short term to raise a Series D round. That D round then allowed us longer term, a sufficient cash runway to negotiate terms with 2 acquisition targets. And that ultimately led to the successful acquisition of Aptus by Medtronic.
Yeah, that I remember that, and that was a very good outcome for Aptus. Absolutely. As we all know, as CFOs, things don't always go according to plan. So let's shift a bit to delivering negative news, so to speak. So tell us a story about a situation, Sandy, in which you had to have given one of your CEOs some bad news or tell them something that they really didn't want to hear. How did you present that news? What was the CEO's reaction? And then how did you respond to that CEO?
Well, of course, this one's a tough one because nobody likes to hear bad news. But on more than one occasion, I've had to have difficult discussions with my CEOs regarding inventory and gross margin. Inadequate systems, for example, procurement, manufacturing, inventory control, etc., can lead to poor performance in terms of gross margin, and worse, eat away at your working capital. I have found that inventory management and product margins are the most misunderstood and, quite frankly, often ignored areas in financial management at small to mid-size organizations. For example, one of my companies, a vertically integrated manufacturing business with more than 120 million in annual revenues, didn't even have an inventory tracking system or a cost account in place when I joined them. They were writing off incredible amounts of scrap and excess raw materials each quarter, directly affecting their margins. I've also had to tell CEOs that the price point charged for a given product was not sufficient to reach profitability. My approach to presenting bad news is always to present it armed with data. I demonstrate and educate with the numbers, stripping out any one-time or non-recurring anomalies. At one company, the fully burdened cost to manufacture a product exceeded the product sales price by a considerable amount. In this case, my CEO believed that the product cost would come down at higher volumes of production when we were at scale, ultimately resulting in positive gross margins.
You know, I hate to say this, but that's not atypical for CEOs, particularly in medtech. And of course, bringing down those margins doesn't happen as fast, right, as the CEO wants it to. And then, of course, it falls in the lap of his or her CFO, kind of holding the bag to figure out how to bring down those operating costs significantly to get to a positive gross margin. So I've seen it so many times in my career. It unfortunately happens a lot.
Yes, it absolutely does, happen, quite a bit. And, in this situation, I responded that, yes, he was correct that the, cost would come down with volume in the future, but we weren't at scale today,
Right.
and we wouldn't be
Totally.
at scale for at least 2 to 3 years.
Exactly.
So it took several quarters of continuously providing the required analysis before I successfully persuaded him that we needed to set prices based on current production volumes, not for a level far out into the future.
Totally get it.
As the CFO, I know it's always my responsibility to shed the same light on the not so good parts of the business as the good parts, even if it isn't always comfortable for me to do so, or for any CFO to do so.
Right. I mean, that's our job, and
Yes.
our authenticity and our veracity, so to speak, is really most important, in my opinion, in terms of being a CFO, having your own agency, right? To tell a CEO, this is not right, or this is not going to get us to where we need to be. So we have to kind of relook or rethink at certain things. So
Absolutely correct.
It's a tough job being a CFO, but it's really a great one if you can, always do the right thing, so to speak. So, as I mentioned, our job, right, as CFOs is to tell the truth to a CEO and the team about what's going on, and to also discuss consequences or unintended consequences of certain behaviors. So all good for our audience to hear. So let's switch gears for a moment and talk about the best company experience you've had as a CFO, and tell our audience what's been your best job and why as a CFO.
Well, I'd say my best CFO experience I've had was at Lipid Sciences, where I spent 8 years of my career. It's said that there are 3 P's to success: people, process, and product. So Lipid had a great team of talented individuals all rowing in the same direction. Egos were definitely checked at the door. Everyone was solely focused on bringing the product to life. Their product focused on a process called delipidation, whereby lipids were extracted from plasma, reinfused back into the patient, and created a supercharged HDL, if you will, the good cholesterol. I was brought into Lipid to create the 3rd P, the process, both operationally and financially. It was at Lipid Sciences where I completed that reverse merger we discussed earlier. Very few reverse mergers were done back then, and certainly not with a company outside of the life science sector.
I remember, you're right.
Post-merger, in addition to the cash on the balance sheet, I had 60 million of real estate assets and loans I needed to sell in order to fund the ongoing biotech business. I had never done that before. I discovered that at Lipid, there are 2 other P's needed in these types of situations: passion and perseverance. I also believe in a strong partnership between the CEO and CFO. This critical partnership stems from trust, respect, integrity from one leader to another. These are all very important elements to me. I was very fortunate to have that at Lipid as well. Lipid Sciences checked all those boxes for me, and it's an experience I continue to build upon throughout my career.
You know, that's so interesting because I had the same kind of relationship. My first go out, so to speak, with a med tech company, and that was at Nelcor Puritan Bennett. I was general counsel, then CFO, spent 8 years there. It was my seminal job. And it really was because of that trust between myself and my CEO. I was completely transparent with him. He knew that. And I think that partnership really helped drive the success of the business, right?
Absolutely.
Because if those two are in sync, it's all good. It's all good. So as we know, the life sciences sector had been on a financing boom over the past few years, and then it all stopped last year in 2022. So tell me your thoughts about, as we move into 2023 and 2024, what do you see in terms of this boom bust cycle and its impact on financing strategies for life science companies, especially those looking to expand their horizons via commercialization? Tell me your thoughts.
Well, just as you said, the financing boom for the life sciences came to a standstill in 2022. And I believe the financing environment will remain challenging at least through the end of 2023. Uncertainty in the markets has only increased for investors with rising interest rates and 3 bank failures this year. Creative financing solutions will be absolutely necessary. And while non-dilutive financings are always more desirable, frankly, this may not be a viable option with fewer and fewer choices in these challenging times. Companies should expect to pursue equity financings if achievable, but these will take longer and carry stiffer terms than in previous years, resulting in greater dilution. In addition, life science companies considering commercialization should go at it at a slower pace, just like we talked about previously, demonstrating results in identified territories before hiring a large field sales force domestically and certainly internationally.
Totally agree with you. What I'm seeing is just a very, very kind of moribund capital markets right now. And I would not be surprised if that goes into 2024, at least the beginning part of the year. So
I would agree.
We'll see, but I think that your advice to companies is right on. So as we wrap this CFO Insights interview up, I have one last question for you, Sandy, and that is, tell me about where you would like your focuses to be at FLG.
Well, I'd like to continue to leverage both my operational and financial experience, assisting both large and small life sciences and healthcare companies, both private and public, as they pursue their paths to growth. Companies find themselves needing a fractional CFO for so many different reasons. They might need an interim CFO while they wait to fill a longer-term need or complete a specific strategic transactions, such as raising capital, like we've been discussing. And many smaller companies simply just don't need a full-time CFO, but they still require the deep expertise and immediate value add an experienced CFO can bring to the table. I can assist in all these situations, whether it's getting a company back on track in a difficult situation or helping build operational infrastructure for longer-term success. I really look forward to bringing my 30 plus years of experience as a CFO in the life sciences to FLG clients.
Well, we are thrilled that you have joined us, Sandy, and I know that your background is going to find much traction with the opportunities that we have at FLG. So I'm thrilled that you're with us. So thank you today for joining us, Sandy, and thank you to our audience. We hope you enjoyed Sandy's perspective on being a CFO in a growing and commercializing med tech company. And for all of you in the audience, be sure to join us for our upcoming roundtable later this year, which is how to handle challenging boardroom dynamics and how to deal with bad boardroom behavior. So we'll have a lot of fun with that one. Thanks so much, everyone, for joining us today. And thank you, Sandy.
And thank you.